Bonds payable. Bonds payable are long-term liabilities. We will walk through some examples to demonstrate the accounting issues surrounding bonds. Specifics on bonds. Companies often obtain financing for large projects through the sale of bonds. The sale of bonds do not affect corporate ownership percentages. So in other words, if you own 51% of a corporation and you are the majority stockholder, if you sell a bond in order to finance a project, it won't affect your ability to be in the catbird seat or to have the largest ownership percentage and thus be able to navigate the company as you see fit. Bonds are an attractive purchase because the interest paid on a bond is tax-free and it will be paid twice a year. Bonds carry a par or face value. The bond issuer agrees to pay back the face value of the bond at maturity. Bonds payable will always be in the general ledger at the face value of the bond. That's what's contractually agreed to be paid back at maturity. Additionally, the bonds carry an annual stated interest rate. So if you have an annual rate, say if it's $10,000, half of which will be paid twice a year to the bondholder. So half of $10,000 would be $5,000, and typically bonds interest expense, the cash paid out on a bond is paid out on June 30th and December 31st. Bonds are traded on the open market, and thus their stated rate of interest may be the same as the market rate, but more than likely it will be higher than the market or lower than the market. When the interest rate is the same as the market, the bonds will sell at par value. When the interest rate is higher than the market rate, the bonds will sell at a premium because the bond rate is more attractive to investors. If the bond rate is 10% and the market rate is 8%, then investors will gravitate to the bonds. When the interest rate on the bond is lower than the market, the bonds will sell at a discount because the bond rate is less attractive to investors. If the bond rate is 6% and the market rate is 8%, most likely investors will go with the market rate because that investment is more attractive. However, investors will purchase a bond, but only if they can buy the bond at less than face value. So let's look at some bond-specific issues and how we would record some journal entries related to it. So in this instance, we have an $800,000 bond. It's a 20-year bond, and it's yielding 9%. The bond is being issued at par. Well, at issuance, that means that the cash that is being received is the same face value as the bond, so the cash received by the company will be $800,000, and they will also record bonds payable at $800,000. Now, let's look at the interest expense journal entry that would be recorded both on June 1st and again on December 31st. Well, $800,000 times 9%, remember 9% is an annual interest rate. So now, since it's being paid out twice a year, we're going to divide it by 2 to recognize the journal entry for June 30th and the journal entry for December 31st. They will make this same entry for 20 years on June 30th and on December 31st. So the bond interest expense will be $36,000, which is half of $72,000, which would be the annual interest rate. And the cash paid out will be $36,000. At maturity in 20 years, they will pay back, the company will pay back the contractual rate, the contractual par value of the bond, which is $800,000, and this journal entry represents payout at maturity. So the bonds payable would be debited, it would no longer exist, and cash would be paid out in the amount of $800,000. So let's look at issuing bonds between interest dates. If bonds are sold after the issue date, the bond purchaser must pay interest related to the bond in addition to the bond face value. Well, why is that? Well, I'm going to explain it a little bit later on, but it's an administrative tool for the bond issuer to be able to track who they owe interest to. For example, if 60 days have passed since a $100,000 9% bond was issued and $1,500 of the interest has been earned, the bondholder would pay cash of $101,500, interest payable the $1,500, which would be the interest that's been earned since the bond was issued, so because it was sold after the issue date. The bond payable always remains the face value of the bond. Now, when they will pay their first interest payment, the journal entry will be to debit this interest payable because it is no longer due to the bondholder. The bond interest expense in this instance alone would be $3,000, and the cash paid out would be $4,500. In the next time that they pay out the cash interest on the bond, there will be bond interest expense of $45,000 and cash of $45,000. But the interest payable was only needed because the bond was sold after the issue date. Now, why is this done? It's done for administrative purposes for the bond issuers to avoid confusion if there are numerous bond purchases on various dates. So every one of the bond purchasers would essentially prepay the interest on the bond, and the bond issuer would recognize a payable, meaning they know they have to pay back to this bond issuer this amount of money, and so that's configured and calculated at the date of the purchase of the bond. So when they go to pay the interest, they'll be able to match this with the individual bondholders, and they won't have to go and calibrate and calculate different cash payments out to individual bondholders. They'll pay everybody out the same amount. Now, let's look at a $100,000 2-year 12% bond. The bond is selling at a premium. The market rate is 10%. This means the bond is issued at 103.546%. Now, we're going to use the same format for each individual calculation, whether it's a premium or a discount, and it will help you accumulate all of the information that you will need for total general ledger interest on the bond, periodic interest expense, the cash payment, the premium amortization. It will give you all of the information. So it's a sort of a dual purpose calculation, but instead of calculating or learning how to calculate a myriad of individual calculations, we're going to use one format and get all of the information that we need in the one format, and the format will be the same whether the bond is selling at a premium or a discount. So let's look at this. The face value. In this column, we're going to calculate the interest cash payment that will be made in June and December. On this side of the calculation, we're going to look at how to calculate the premium or amortization. And by adding these two together, we will also be able to figure out the periodic interest expense associated with the bond. So let's look at the calculation. The face value of the bond is $100,000. The annual interest rate is 12%. So 12% times $100,000 means the annual cash interest is $12,000. Now let's look at this. What is the total cash interest over the life of the bond? Well, this bond will be outstanding for 2 years, so the total cash interest over the life of the bond is $24,000. Now, why do I set it up like this? Because a lot of times you'll have test questions or homework questions that may ask you specifically that. So I'm trying to make this calculation a one-stop shop for you to be able to calculate everything that you could possibly be asked related to bonds. So now let's look at, this is the total cash interest over the life of the bond, the 2 years. But now let's look at what we are going to pay each June and each December. So let's look at the total periods the interest will be outstanding, which is the number of years associated with the bond, which is 2. And then we're going to multiply that by 2 to say that this is related to, this bond has 4 periods of interest that it's going to be paying. So taking $24,000 and dividing it by 4, it means the cash interest payment paid out in June and December will be $6,000. Now let's look over here at the calculation of the amortization of the premium, because the bond has been issued at a premium. And wait, let's look at that. Before we look at the calculation, let's look at what's happening on the date of issuance. So the cash that we receive, since the bond is selling at a premium, remember, this means the market rate is 10%, the bond's at 12, so this is more attractive on the open market to investors, so they're willing to pay a premium. So the cash that they will receive will be $103,546, which is the 100,000 face value of the bond times what it's been issued at 103,546. This means the bonds payable will always be $100,000. Bonds payable will always be the face value of the bond. The difference between the cash and the bonds payable is the bond premium, and that will have to be amortized over the life of the bond. So this is what we're trying to calculate on the bond premium. Over here, we're trying to determine how much are we going to amortize each period of the bond premium, because we want to bring that down to 0 at the end of 2 years in order to bring the bond carrying value down to the 100,000 contractual rate. So in this part of the calculation, we have the face value of the bond, and then we have the cash paid out for the bond. In both a calculation for the premium and the discount, we're going to subtract the cash paid for the bond. So our cash interest over the life of the bond is $240,000. To that, we are going to subtract the negative, or add the negative, $3,546. $20,454, which is the $24,000 minus the $3,546, will equal the total general ledger interest on the bond over the life of the bond. Now we're going to divide that premium by the total number of periods that we're going to amortize it, which will be 4 premiums, which is the total years outstanding times 2. So this means our premium amortization each and every time we pay interest on the bond is going to be $887. This plus the $6,000 interest, and really it's a subtraction, but $6,000 minus $887 means the periodic interest expense on the bond is going to be $5,113. So let's look at that. Let's build this journal entry based upon what we know. We know that we're going to pay out cash of $6,000 associated with the life of the bond. Now, the bondholders don't care about the internal mechanism of the company to recognize what's the bond interest expense and what's the amortization of the premium. All they care about is the fact that they're going to get $6,000 in June and $6,000 in December. Now, the bond interest expense we've calculated here, looking at the cash payment, subtracting out the amortization. So that will be the bond interest expense. And the bond premium amortization is going to be $884. That number there, $887. Okay. And so now let's look at the amortization of the bond premium and what happens there. So we credited bond premium to begin with. And then on each successive date when we pay out interest, we are going to amortize the bond premium. So $887 from $3,546 means our bond premium now will have a balance of $2,659. Again, another amortization. Now our balance is $1,772. Again, another amortization. Our bond balance is $885, and our last entry will be $885, bringing the premium down to 0. And then at maturity, the bonds payable when we pay it off, again, it's always based upon the contractual face value of the bond, and then we'll be paying cash out $100,000. So pause and print this page, and we'll use the same thing when we look at a bond discount. So in this instance, we have a $100,000 bond. 2 years is an 8% bond. It's selling at a discount because the market rate is 10%. The bond will be issued at 96.454%. Face value $100,000. The annual interest rate is 8%. The annual cash interest is $8,000 times the number of years outstanding will be times 2. So the total cash interest over the life of the bond is $16,000. We're going to be paying that twice a year, so let's take that into consideration when we figure out how much cash we're going to pay every period. So the number of years that the bond is outstanding times 2, because this represents June and December, we're going to divide the $16,000 by 4, and this means our cash interest payment that we'll be paying to the bondholders is $4,000. Again, the bondholders are only interested in the $4,000. The rest of the information that we're looking at in amortizing and periodic interest expense is only an internal accounting GAAP regulation journal entries that the company has to make. So let's look at the amortization of the discount. Again, $100,000 face value, and we're going to subtract the cash paid for the bond. And in this instance, it's going to be a positive number. So $16,000 plus $3,546 means that the total general interest on the bond is going to be $19,546. So to figure out how much our amortization is, we are going to divide that by 4 periods, and our discount amortization is going to be $887. $4,000 plus the discount amortization means our periodic interest expense is going to be $4,887. When the bond is issued, it is issued and we receive cash in the amount of $96,454. Our bond discount is $3,546, and again, our bonds payable will always be the face value of the bond, so it's $100,000. Now let's look when we pay on the interest expense. We know we're paying out cash in this amount. Our bond amortization on the discount is this amount. Our bond interest expense is $4,887. That will be paid on June 30th. This journal entry will be recognized on June 30th and December 31st for 2 years in a row. At maturity, we're going to debit bonds payable to show that we no longer owe it and make a cash payment out of $100,000. Let's look at the amortization of the bond discount. This was originally debited, so all of our discount amortization will be credits. And so we can see that each time we amortize the discount, we're bringing the balance in the bond discount down, incrementally down, and then at the end we will have a 0 in the balance. Now let's just look at a recap of all of this. This is the bond issued at par and all the journal entries. This is a bond issued at discount, calculation, the journal entries, amortization of the discount, the bond premium, same calculation, journal entries, amortization of the bond premium. I brought all of this back together again for you to look at it one more time, so if you want, pause and print this out, and it should help you on your homework as well as if you memorize this on a test. Now let's look at one more issue with relationship to bond. Bond retirement before maturity. When bonds are sold or otherwise retired before maturity, the carrying value of the bond must be taken into consideration. The carrying value of the bond is described as the stated face value of the bond and the general ledger balance in the bond premium or the bond discount account added together. So how does that look? In this instance, we have a bond payable with a premium. The premium is credit-based. The bond also is credit-based, right? So it's a liability, so it will also be credit-based. So the two of them added together would give you the carrying value of the bond, which in this instance represents $102,659. In this instance, we also have a bond payable at $100,000, but there's a discount on the bond, which is debit-based. So with the credit-based bond and the debit-based discount, we're going to have a reduction, and so the carrying value of the bond will be less than the face value of the bond. In this instance, it's $97,341. So what are our steps when we retire a bond? First, we want to debit bonds payable. That's going to, because this is credit-based, that's going to effectively take this off of our books. By debiting it, it will zero out the bond payable on our books. Next, we want to record the cash that we're paying out, so we'll credit cash. Then we want to debit bond premium. Remember, it's credit-based, in order to take it off the books and effectively zero it out. Or we want to credit the bond discount, again, debit-based, so by crediting it, we are effectively taking it off the books. If the difference between those three entries is a debit, then it's a loss on bond retirement. If it's a credit, then it's a gain on bond retirement. So let's look at that calculation. In this instance, we are going to, this is the carrying value of $102,659, and we're going to repurchase the bond for $103,400. Debiting bond payable, debiting the premium, crediting the cash. The difference between those three journal entries, the amounts, is going to be $741, and so that's going to be a loss on bond retirement. So whenever we have a debit as the result of putting together the first three pieces of this journal entry, it's always going to be a loss. If it's a credit, it's a gain. So let's look at this, how we calculate the fact that it's a loss. Well, our carrying value is $102,659, but we had to pay $103,400 in order to retire it. So that means there was a loss of $741. Now let's look at it when we have a bond discount. So the bond is also going to be repurchased at $103,400. So we're going to debit bond payable. We are going to credit bond discount. Remember, it's debit-based, so credit this in order to write it off. We're going to credit cash for the amount that we're paying out. These three journal entries these three amounts in the journal entry taken into consideration, there's a difference of $6,059, and that is a debit, which is a loss on bond retirement. So again, if this part of the journal entry winds up being a debit, it's a loss. So let's calculate that. The bond's carrying value, $97,341. We had to pay out $103,400 to retire it, and so there was a loss on the transaction. So now let's look at it if we repurchase it for $95,000. So again, bond payable, we're going to debit it for the par value of the bond. We're going to credit cash for the amount that we're paying out. We're going to debit bond premium. The difference will be a credit, and that will be a gain on bond retirement. So our bond carrying value was $102,659. We paid out $95,000 in order to retire it, so we had a gain on the transaction of $7,659. Now let's look at it when we have a discount on a bond. The bond was repurchased for $95,000, bond payable $100,000, crediting the bond discount and also crediting cash. We see that we have the remainder is a credit, and so that would be a gain. So credit and when it winds up being the part of the entry winds up being a credit, it's going to be a gain. And let's calculate that to verify that. Bond carrying value $97,341, cash paid out $95,000, and yes, there's a gain on that transaction.